in the fixed rate market and the floating rate market, and how best they could get together and structure a interest rate swap so that both can enjoy a benefit, in terms of interest rate structures, preferential interest rate structures they have. Now, think about a case where the firm may, in this particular case, has advantage in the fixed rate market, comparative advantage. I mean, in both markets, fixed and floating, the firm A has advantage. But if you look at comparative advantage, looking at the differentials, the firm A has a competitive advantage in the fixed rate market than floating rate market. So that means the firm B has a comparative advantage in the floating rate market. Now say each firm wants to borrow in the other market where they have a less comparative advantage, right? So assume that firm A needs to borrow in the floating rate market. Firm B wants to borrow in the fixed rate market. Okay, so each firm does not have a advantage in that particular market, comparative advantage, right? So how do you structure a interest rate swap so that both parties can benefit out of the deal, right? So how many of you tried that question, and are there any answers before we discuss? Anybody can structure a swap? Anyone who tried that home? Can anyone tell? Oh, even now, the possible. I mean, there may be many options. I mean, many ways of doing this. So there is no one answer, but there may be. So we have to work out and see whether each party has an advantage out of the deal. Can someone tell? Anyone who tried at home? Can someone tell the answer? Answer in the sense the particular structure. How the two firms can get together a dealer structure. Can no one? So you should be able to think and structure, because we discussed example previous day. So similarly here, you should be able to do it. Can we hear from someone? use the benefit. Each party has its own market and structure interest rates up. So last time we discussed how interest rate swap can be derived between two banks, remember? And ultimately, how each party save $40,000. Can someone do it, please? And don't worry, if you make a mistake, give a try, because in the exam, if you get a question, then definitely you have to do it. I mean, you can't wait without answering. Can I ask someone? There are a few I can see. Those who talk also not silent, pretty silent today. Tell me one way, at least, you can give a try and see, I can put it on the board, no point.
So this is, we have to take this as a plain vanilla interest swap, and the housing bank granted housing loan at 15%. So that
No,
is for
this is not the housing bank question. This is not the housing bank question, the previous one,
okay.
which is this one. We are discussing this one.
Okay.
This one we are discussing.
Okay.
So how the two parties can get together and work out? Think about a couple of minutes and, So there is no one particular answer for this. So there may be so many answers. I need one. But ultimately, both have to get the benefit out of it. No one? So let me put on the board. Firm A, firm B, fixed rate 10% and 14%, floating rate LIBOR plus 0.5%, LIBOR plus 1.0. Right.
Sir, excuse, board is not visible.
Yeah, I will come to it.
Okay.
Okay. So can you see the board now? Can you all see the board?
No, sir.
Can?
not visible to the screen.
Huh?
It's there, but it's far, not visible very closely.
Can you see now?
Yes,
Okay. So what we can do now, firm A can borrow in the fixed rate market at 12%. Firm B can borrow in the fixed rate market at 14%. That is given in the question. In the floating rate market, firm A need to pay LIBOR plus 0.5%. Firm B need to pay LIBOR plus 1.7%. So how we can get together and structure a swap, right? So in which market firm A has comparative advantage? In which market? In which market? What is the market? Firm A has a comparative advantage. What is the market? Firm B has a comparative advantage. Can you tell me? Huh? I mean, you have to understand this. If you don't understand this, you can't do it. Which market firm A has a comparative advantage? Which market firm B has a comparative advantage? Hmm? Which market? Can someone tell which market you have comparative advantage? Firm A and firm B. Hmm? Each firm has a comparative advantage in a particular market, right? So which market firm A has advantage and firm B has a comparative advantage. Can someone tell which one has a comparative advantage in fixed rate market, which has a comparative advantage in floating rate market? So that is the first thing you need to understand. Without understanding that, you can't structure a deal. You need to know the comparative advantage. Can someone tell which one and why? Well, that is the important thing. I mean, we can structure a deal, but without knowing that, very difficult. Right? Can we hear from someone? Can we hear from someone about that? You have to talk, otherwise I tell you, I can't just talk and talk. You have to respond. If you don't respond, I don't know whether you understood or not. If you are in the class, definitely you have to respond. We'll ask somebody. Yuresha, what do you think? I can see Yuresha.
So basically, if we go by the interest rate markets, the firm A is operating has the lowest fixed rate and the floating rate. That's like plus 0.5. So if we take firm B comparatively, the floating rate of firm A's market is feasible for firm B. So any swap arrangement should be like firm B will be okay. Any interest rate lesser than 14% fixed rate or like plus 1.7 floating rate. But for firm A, the rate should be lesser than like plus 0.5 or 12% fixed rate.
Oh, okay. You came up with the answer, but what I want to know is which now let's say firm A, in which market it has a comparative advantage. Firm A. Which market firm A has a comparative advantage? Which market firm B has a comparative advantage?
So, which market means?
Which floating rate or fixed rate market?
Ah, okay. So, for firm B, it should be floating rate market.
Mm-hmm.
For firm A, if it can be either floating rate or fixed rate both because
No, there can be both, no?
both. So
Each
it
firm.
should be fixed rate.
Yeah. Okay. So that is what first we have to understand. Now, if you look at the differentials, if now if you look at the interest rate, firm A has a lower interest rate in either market, right? Whether it borrows in the fixed rate market or floating rate market, its cost of funds is cost of borrowings is lower. So that is the advantage. The firm A has advantage in both market in terms of interest rates because it pays a low interest rate. But in terms of the comparative advantage, if you look at the differential, in the fixed rate market, the differential is 2%, right? 2%. Differential is 2%. In the floating rate market, differential is how much? 2%. Okay, 2% and sorry, 1.2%. I put this way. It is in the hand note. I'm just repeating it. So here it's about 2%. Here it's about 1.2%. So that's why we say firm A has a comparative advantage in fixed rate market. Firm B has a comparative advantage in floating rate market. Okay. So comparative advantage from in point of comparative advantage, firm A has a comparative advantage in the fixed rate market. Firm B has a comparative advantage in the floating rate market. Right. So how they can get together and structure a deal, right? Okay. Now, so that means each firm should borrow in the market which it has a comparative advantage and do an interest rate swap. So that is the idea. So each firm can do borrow in the market which the firm has a comparative advantage and do a swap so that ultimate benefit will go to each party in the other market, right? So that is the idea. So let me structure a deal. So that let's say firm A can borrow in the fixed rate market at 12%. So let's say firm A borrow from B1 at 12%. So that firm A has to pay 12%. Firm B borrow from B2 and it has to pay LIBOR plus 1.7%. Okay, because when they borrow in their own market, they have to pay this, right? Then, okay, firm A and B get together and structure a deal. Okay, firm A says, okay, there is one way of doing it. I will give you 13.6%. Okay, so you pay me 13.6%. Okay, 13.6%. And we say, okay, I pay you 13%, you give me my LIBOR plus 1.7%. Right? LIBOR plus 1.7%. So now if you look at the structure, interest cost to firm A equal, now it receives 13.6%, pays 12% and pays LIBOR plus 1.7%. So that means its final cost would be minus LIBOR plus 0.1%, right? For the firm B, interest cost would be, it receives LIBOR plus 1.7%, pays LIBOR plus 1.7% for the borrowers, and pays 13.6% to the firm A. So its cost would be minus 13.6%, right? Can you all see that? Can you see that, please? Okay, somebody has it. Yes, somebody want to ask a question? Is it okay?
Sir, can you repeat it again for the explanation? Now the firm A has the comparative advantage on fixed rate.
Yes.
Then it will borrow from the outsider as well as it can borrow to B.
No. It can't
It
borrow
can
from
lend
B.
to B.
It can't borrow
It can
from
lend to
now
B.
let's say firm A in the fixed rate market has a comparative advantage in the borrowing from a whatever lender, right?
Yes. Yes.
So firm A can go to the fixed rate market and borrow at 12%, right?
Yes.
So now firm B also has a comparative advantage in the floating rate market, right?
Yes, sir.
So then firm B can borrow from someone at LIBOR plus 1.7%.
That's okay. Okay.
So this is what happens when they borrow in their own market, right? Clear?
Clear, sir.
Okay.
Okay.
Now what they do is, now let's say they don't have any connection. Okay.
Yes.
So if they want to go to the individual markets, this is how it happens. So what they can do is, now they can get together and firm A can say, okay, I will give you, I will quote an interest rate of 13.6%. Okay, fixed rate. You pay me LIBOR rate. Okay.
Okay.
So A tells B, okay, you pay me 30 because I can borrow at 12%, no?
Yes.
Firm A, I will say, okay, I will give you 13.6%, you give me LIBOR related rate. Okay, because that floating rate market, I have a comparative disadvantage. Always the comparative disadvantage, right?
Yes.
So then firm B say, okay, I'm fine. Okay, you give me 13.6% fixed rate. I will give you, okay, you pay me LIBOR plus 1.7%, right? So this is the structure. Now look at the cash flows. The cash flows in the sense interest rate structures. So for A borrow at fixed rate market how much?
12%.
12%. So the A's cost in the borrowing is 12%, right?
Yes.
Okay. Now A agreed to
Sir,
pay.
we can't hear you.
Huh? Hello? Can't you hear me?
We can hear you, sir.
Can't you hear me?
Can hear.
We can hear, sir.
Okay. Can you all hear me?
Yes,
Yes,
sir.
sir.
Okay. So now, as I said earlier, so the A can borrow in the fixed rate market at 12% and come to a swap agreement with B. Okay, A say, okay, I will give you a fixed rate of 13.6%. And B say, okay, I can borrow in the floating rate market at LIBOR plus 1.7. I will pay you how much? You will pay me LIBOR plus 1.7%, right? So if you look at the overall cost to the firm A, so firm A receives 13.6% from B and pays 12% for its borrowing and also pays LIBOR plus 1.7% for the B. So the final cost for the A is LIBOR plus 0.1%, right? Clear? You have to answer. I don't know whether you understood or not. So what is the final cost to the firm A? So what is the final?
LIBOR plus 3.3, sir. Because 13.6, they can borrow, and 12% on a fixed rate. Hello?
So what is the cost to the firm A? Final cost. Final cost. Final cost to the firm A. You can see the board, I think. Tell me. Now it is on the board. What is the final cost to firm A? As a result of this swap? Huh? It is given. What is the final cost?
LIBOR plus 0.1.
LIBOR plus 0.1%, because
Yes.
when you net off the inflows and
Yeah.
outflows, LIBOR plus 0.1%. So what is the cost to the firm B, final cost? Firm B, I have put it in the board. What is the cost to the firm B?
That is to LIBOR plus 0.1 because of 14 minus 13.6 plus LIBOR plus 0.5.
Sir, you are on mute, sir.
Okay, so what is the cost to the firm B as a result of this swap? I mean, you will have to talk, otherwise how do I know whether you understand the very basic thing? I don't know whether we can have physical classes. It's not going to serve any purpose. If you don't respond, if you don't answer, maybe you may be wrong, but there should be a discussion. Otherwise, how do I know? I can't see you all. It's just a one-way talk. I mean, it's pretty simple, things I ask you. I mean, you will have to respond. Otherwise, how do I know whether you understood not? But please do that. You are professional bankers. Most of you have some years of experience, as you mentioned at the beginning. Otherwise, this will not serve any purpose. So what is the cost to the firm B? Because I have put it on the board.
Firm B to LIBOR plus 1. LIBOR
Sorry?
plus
LIBOR plus? Firm B. I am asking
0.1
firm. Huh?
because they can lend
No, I have given a structure.
from
I have now put it.
B also same because 14% is
No, I have put a SOP deal now.
okay.
So as per the SOP transaction, what is the final cost? Now we derived the SOP transaction now. So tell me, what is the final cost?
It's 13.6 for the B.
B for
Yeah.
A. For A.
LIBOR plus 0.1%.
Yeah, so it's pretty simple. I mean, if you look at the interest rate structures, you do the interest rate structures, and for the firm A, cost to the firm A is LIBOR plus 0.1%, and cost to the B is 13.6%. Right? So it's a pretty simple answer. I mean, Sumuthu, I think you will have to, this is just look at the board, nothing else, just as per the structure. You see? So this is, I mean, if you all see this? Can you all see this clearly?
No, sir.
Huh?
No, sir.
Huh?
Not clear, sir.
No.
Can anyone see? I have put it in writing.
No. Now it's clear.
Now clear?
Yeah.
Okay. So this is the same thing I put on the board. Okay. So this is the so, I mean, one way of doing this. So I always tell, this is one way of doing this. So there may be so many other ways of doing this. So, right? Can you all see this? Can? Can, no, can't.
Now it's clear, sir.
Okay, so this is the structure, same thing I put on the board. Okay. So the final cost to the firm A is LIBOR plus 0.1% in the floating rate market, and firm B 13.6 in the fixed rate market. Okay. So what has happened now? Tell me now, when you see the numbers, because of the interest rate shock, what it has led to? What it has led to?
Both entities has benefited in the floating and fixed rate markets.
Sorry?
Both entities has benefited in both
How
floating
can you
rate.
tell? Both entities have benefited. How? Tell me which way. Little bit further explanation.
So actually, firm A earlier they used to pay LIBOR plus 0.5 for their floating.
Yes.
Now, whereas they has benefited that it has reduced to LIBOR plus 0.1.
Yeah. So
And,
what? 0.4% benefit.
Yeah, and firm B it was 14% fixed,
Yeah.
and now they are paying 13.6.
Okay. So it's again another 0.4%. So this is the beauty of the SOP. Now, because of the SOP, any firm can borrow in the market which it has a comparative advantage. Now, A has a comparative advantage in fixed rate market. I am talking about comparative advantage, not the advantage, because A has advantage in both markets over B. Okay, but here comparative advantage A has in fixed rate market than B. So B has a comparative advantage in borrowing in the floating rate market. So A borrowed in the fixed rate market at 12% and structure a SOP. As a result of that, if A wants to borrow in the floating rate market, he brought it down to the LIBOR plus 0.1%, right? LIBOR plus 0.1%. So that's a 0.4% benefit. Now think about a borrowing of 100 million. Now let's say now why this interest rate structure is interest rate swap is agreed for a particular borrowing. They may not borrow between each other. A will not be borrowing with B, but they got together and structure an interest rate swap so that they will benefit in the borrowing that which they are going to raise through some other party, right? So let's say 100 million worth borrowings. So it's a 0.4% saving means fairly large sum. Okay, fairly a large sum they save. So similarly, firm B, if they borrowed in the fixed rate market, it had to pay 14%. If they didn't have this swap, now they can pay only 13.6%. So that's again another 0.4%. So through this swap, both have got an equal benefit. So both have ended up with paying 0.4% in the market which it has a comparative disadvantage, right? So that is the benefit of a SOP. Remember, that is the benefit of a SOP. Okay. So I think you should now, if you, maybe somebody else can work out another SOP, which will give a different benefit. But at the end of the day, whatever the way you structure the SOP, both should get a benefit out of that. Otherwise, no one will engage in a SOP. No? So this is one way. I just gave an example of one way of doing this. So there may be so many other ways. So now if you have a question, don't worry. Let's say someone tell after the exam, I structured this SOP in this way. And someone else says, this is the way I did. So don't get confused because no. Both are wrong. So both may be right. Okay. So that's the way we can structure a SOP. Clear? Any question before we move? So if you are given a comparative advantage scenario in different markets, you should be able to structure. So now this is very important when you deal in different overseas markets. Now, for example, now you want to borrow in dollars and you want to borrow in sterling in different countries. So each country has a different advantage, in different markets, so that you can structure a SOP accordingly. Okay, so we'll move on to the next area. Okay, so this is one way. There may be so many ways. So similarly, I'm not going to answer this one. Try at home. A housing bank has granted housing loans at 15% interest rate for 5 years. The main source of funds to the bank are deposit of 1 and 2 year maturities. So for which interest is paid at TB plus 3%. So there are again, what is the risk to the bank here? What is the risk to the bank? Can someone tell? Risk to the bank?
Declining interest rates.
Declining interest rates. Anyone else? Everybody agree with that or no? What is the risk to the bank? So one said declining interest rate. Any other views? Any other thoughts? Can someone else give any answer? For 33 joined the class, so only one give an answer. What about others? Because if you don't know the risk, you can't manage the risk. That's the first principle. So you have to identify what is the risk first. Without which you can't identify what is the risk management I am going to use. So what is the risk to the bank? Can we hear from someone else, please?
Deposit
The risk
rates
of depend
are
on the
Sorry? Yeah, gentlemen, you can talk first.
risk is depend on the next 3 years rate.
Yeah, so risk is dependent. So what is the risk? I mean, what sort of a risk is there depending on the future? But what is it?
deposit rates are based on treasury bill plus 3.
Yeah.
So the treasury bill rates, it's very sensitive, and if it, according to its fluctuation, we are
Yeah.
unable to match with the housing loans.
Yeah. So what is the risk? I'm asking very specific question. Okay. Interest rate risk is the one. That is right. But how? Which way? So which way you are exposed to risk?
If there is a positive gap, interest rate increases it assets.
No, no. What I'm asking interest, but from terms of interest rate, I know the depending the gap, it is different. But how it affects?
If the rates increase, it's the risk.
Yeah. If the rates increase, exactly. So the risk is interest rate risk. So basically, the assets are priced at fixed rate. The liabilities are priced at floating rate, TB plus 3%, right? So the risk is due to the mismatch. That's all right. But just because of a mismatch, you will always not encounter risk. The possible interest rate rise will have a significant risk. Okay, the possible interest rate rise. Because whenever the interest rate rise, what happens? Your expenditure for liabilities will increase, but income from loans will remain same. Because loans you get 15% over the next 5 years or whatever years. But whenever the interest rate goes up in the market, that means treasury bill rate will definitely go up. As a result, your interest cost to the depositors will be higher if the interest rate goes up. So the potential risk is rising interest rate in the market. So that is the point. So you have to be very specific. Okay, what is the risk? Risk is rising interest rate in the market in the future. So what you can do, so you can, once you enter into a swap, you are not worried about the future movement of interest rate. Whether it goes up, goes down, you are not worried because now you are mitigated. So you can, risk management is that you can close your eyes and sleep. Even forward contract, that's what I said. Even if you enter into a contract, it may be better for you to, without having the contract, if the expectation do not materialize in the future. But we want to have some certainty. That is the objective. So when we enter into a swap, I am not worried about whether interest rate going up or down. I know this is my net interest income depending on the structure. So the risk is potential rise in market interest rates. Potential rise in market interest rate. If it happens, my payment to the depositors will go up, but I will get a fixed rate from my borrowers. So I will end up with a reduction in net interest income. Reduction in net interest income, right? So potential risk. Right? So then you have to structure a swap to mitigate the interest rate risk. Okay, tell me, I am not going to structure a swap. What is the general way of, how can a general way of doing that? I am not looking at asking numbers. So what sort of an interest rate structure would be good for this particular case? So interest rate swap structure. Can someone explain? Anjali? What sort of structure? Don't give the numbers or anything, but structure. Now we know the potential risk in terms of asset structure and liability structure and how we can do it.
Vanilla plain interest rates, one is fixed and other one is floating.
Yeah, tell me exactly how, which one is, how it is going to be due. I know vanilla is okay, but how? Be specific. Don't give broad answers. Be specific how the housing bank can do this. Specific.
Housing
Try
loan
it when
can
you-
grant voting rate.
Sorry?
Housing loan can grant voting rate.
Housing
Loan can grant voting rate.
No, housing bank, no, I am talking about stock because housing bank interest rates are fixed now. It can't grant floating rate unless its future loans will be floating rate. Now we are looking at, now this is the existing structure. You want to manage the existing structure. You see? So to manage the structure, you can now, okay, if you want now, you can go and grant housing loans at floating rate. But now this is the existing. So to overcome the existing structure, how can you manage the interest rate? So how can structure solve? Yes.
We can categorize into three periods: 1 year cash flows and 2 year cash flows against because it's maturing in 1 year and 2 years.
Okay, still, okay. I'm asking a very pretty simple question. I mean, so, okay, you can do all those things, but pretty simple way, to structure a SOP. Now, we did example previously. How did we structure a SOP? I don't want numbers, but tell me briefly, how do we can structure a SOP? Okay, all this can be done, cash flows, all those 1 over 2 year, whatever. Yeah. But okay, tell me if it is 1 year, how do you do it? 2 year, so how do you do it? So that's structuring I want. Maybe for 1 year, maybe for 2 years. So specific, I want very specific.
Take the net differentials from each.
Yeah, but how you can do it, please? Can you tell me how you can do it? The way of doing this. Okay, take the
We
differential.
want to see the comparative advantages from
Huh?
floating rate or fixed rate.
Sorry?
We want to know the comparative advantage in floating rate or fixed
I
rate.
can't hear you, Miss, properly. I can your voice, there's a little bit echo coming. Can you explain it? I can't. Earlier there was a little bit echo sound coming, so yeah, it's not
We need
specific.
to know that the comparative advantage comes from fixed rate or LIBOR plus some interest rate. Floating rate.
Anyway, it's not clear, but it's okay. We'll probably others would have heard it. Anyone else? To enter into a SOP, what is the first thing you need to do?
To identify a bank who's giving fixed rates for the deposits.
Okay, fixed rate for the deposit. Okay. Or other way. So what is the risk? From my borrowers, now always, okay, first thing is you have to identify a SOP counterparty to mitigate risk. That is the first thing. So I have to find out either bank or SOP bank or maybe a SOP broker to find a counterparty for a SOP deal. That is the first thing. So how I can do it? My payments are in fixed rate. My income is in fixed rate. My payments in a floating rate. So what I can give to other parties a fixed rate. I can't give treasury bill or whatever rate to other party because my income stream coming from fixed rate. So discuss with us, identify a SOP counterparty, whether bank or dealer or through whatever, who can give me a floating rate. Because my payments are in floating rate. So I will find a counterparty and tell him, okay, I will give you a fixed rate. You will pay me floating rate, right? So I will tell, okay, I will give you 13% fixed rate. You give me TB plus something, whatever, or TB rate. So if I deal a structure like that, then what happened? my liability payments are protected, because whatever I need to pay in TB rate, I'll get from the sub counterparty in TB rate terms, right? So very simple thing, but numbers we didn't discuss. So you have to decide the numbers for your benefit, both, you know. So what I can do is I can find the sub counterparty where he agrees to pay a floating rate based on the treasury bill, and I pay him a fixed rate. So that is the pretty simple thing. So first understand the risk. What is the risk? That depends on your balance sheet interest rate structure. Okay? Right? Interest rate structure. And then decide, once you identify the risk, then you can decide the right way of doing that. So I think you will have to think rationally, logically, risk. If you don't identify the risk, you can't manage the risk. So while doing this, you need to look at other, I might just look at very micro part of this one. So someone told the gaps, cash flows, so all those need to be looked at. Right? Whether you structure it for 1 year, whether you structure it for 2 years, all this depend on many other factors. Let's say you want to structure this SOP for only 1 year. So it's a 1 year SOP. Maybe you want to structure for a 2 years, then it is 2 years. That depends on how do you see it. You know, depending also the market condition. Now in some markets, you don't find longer term SOPs. So probably you have to do a shorter term SOP and negotiate for an extension. All these also in practical scenario. I'm referring to practical scenario. Now, even certain SOPs, markets are not liquid for more than 2 years. Internationally, you can find SOPs for many years, but in Sri Lanka, you know, it's not maybe 1, 2, maybe like that. So you have to decide, okay, I do an initial SOP for 1 year. Then probably you can look at the interest rate structure and you may either re-enter or not. You see, depending on the interest rate phenomena. So the timing, structure, all those you can decide depending on your requirement in a practical sense, right? Okay, so we took so much time on this. I think you should be thorough. So you should be able to analyze any raise and design a SOP transaction, right? So we'll move on to the next slide. Okay, so this is again okay. Next area is the derivatives, which we called options. Okay, so we looked at the forward contracts, we looked at the futures contract, we looked at the forward rate agreements, we looked at the SOPs. Now these days, it's very much popular, the foreign currency SOP. It's not just the interest rate, you see. Now you will learn when you look at, when you learn foreign exchange risk, you will learn foreign currency SOPs, where there is both the interest and exchange, you know, amount is there. Now if you look at Indian SOP, it's a between Sri Lankan rupee and maybe dollar, if it is dollar rated, dollar SOP, right? So the options are different. Now what is option? Now option, again, a contract between two parties with a fixed price and a time frame, like a forward contract. Okay, forward contracts to buy or sell specified amount or value of a particular underlying by exercising the right prior to or on the contract maturity. An option buy is purchasing insurance for a limited period of time. Now remember, when we discuss the forward contracts, it is an agreement between a buyer and seller to buy from the point of view buyer or holder, and from the point of view of the seller or the writer to sell the particular financial instrument or good at a particular future date at a particular price. Now what is the difference in an option? Now in an option, you have a option itself means you have given a choice. Now, forward contracts, you don't have a choice. Whether market interest rate or whatever is beneficial for you or disadvantage at the time of contract, you don't have a choice. You have to do it. But here, you have a choice whether to go ahead with the option or not, depending on the market price. Now, I'll take a very simple example, not related to interest rate or anything. Let's say a commodity. Now, in Sri Lanka, some time back, we had a forward paddy market, forward contract for paddy. Okay, that's a short term when the harvest is, very high. So there may be, rather than, putting to the normal market, you had a forward market. So let's take example of let's say gold. Okay, so I want to buy some gold. Okay, in the market in 6 months time. Now let's say gold price is now going at let's say maybe per ton, whatever price. Let's say ton example. Let's say 1,000 whatever maybe dollars or whatever. Okay, so $1,000. So if I buy ton, maybe it's not 1,000, it's much more than that, but let's say $1,000 per ton. Okay, so I want to buy 2,000 tons. Sorry, let's say 2 tons of gold in 6 months time. Okay, the current price is, let's say, ton is about 1,500 USD. So what is the risk to me now in this particular game? What is the risk to me?
Increase in the price in 6 months' time.
Increase in the gold price in 6 months' time. So the currently 1,500. If I buy today 2 tons, I have to pay 3,000, right? But I don't want to buy today. I want to buy in 6 months' time. Let's say gold price went to 2,000 per ton. So in 3 months' time, if I buy, how much I have to pay? Sorry, 6 months' time. How much I have to pay?
4,000.
4,000. So that's the increase of how much? Increase of
1,000.
1,000 US dollars. So if I buy today, gold price is 1,500 per ton. So 2 tons, it costs me 3,000. But I don't want to buy today and, utilize my, cash for that. But I want to buy in 6 months time. But let's say 6 months time, I don't do any hedge. I don't do anything. I just keep quiet. So 6 months time, now I want to buy. Now price has gone up to 2,000. Now I have to pay 4,000. So I would have been much better if I had some risk management instrument today. So let's say today I enter into a forward contract, okay, with somebody to buy 2 tons of gold in 6 months time. Let's say the contract price is, let's say 1,700. So today I enter into a contract with party B, okay, to buy 2 tons of gold, 2 tons of gold in 6 months time at 1,700. So today I know into 6 months time how much I have to pay. How much I have to pay?
3,400.
3,400. I know 6 months time 3,400. So once I enter into forward contract, what I can do? What is the safety net for me? What is the comfort I have? What is the comfort I have?
Even if the
Gold
price
price
goes up beyond 1,700, we can buy at the same price.
So my comfort is now I know my cash flow It's only 3,400. So I am not worried about the market gold price, because 6 months later I can go and ask the seller, okay, give me 2 tons of gold at 3,400. So basically I know with certainty my maximum cash flow would be $3,400 in the market. So now let's say we come to the 6 months time. 6 months time, say gold price is, let's say, 2,000 ton. Okay, so I am not worried. So I'll pay 3,400 and ask seller to settle me that. Now let's say, now I have entered into a forward contract. Now let's say, instead of market going up for whatever reason, gold price per ton dropped to 1,200 at the time of my settlement, contract settlement, 1,200 per ton. So what is the scenario? It didn't go up, it came down to 1,200 per ton. So now
I have to pay 3,400.
Huh?
I have to pay 3,400.
Yeah, why?
Because it's a forward contract. I have to accept that.
Exactly. I can't now go and tell seller, no, dear, I enter into a forward contract in the market, so I can't do it, because that's the agreement. So, irrespective of the price decline, I have to pay 3,400 and buy the 2 tons of gold. So that is a forward contract. So it's a contractual obligation. Now, sometimes you may feel, oh, what the hell I did, I would not have entered the contract. But risk management is something which makes certainty, because you know such certainty. I can sleep well. I can pay only 3,400, whatever the market. Now, option is little different. Now, option gives a choice for the buyer to decide whether you can buy yourself. Now, for example, let's say, instead of a forward contract, this company entered into a call option. I will explain call option later. That is right to buy. Now you have a call option, not a forward contract. So at the time of entering, you ask the seller of the call option, okay, I will pay you 1,700 per ton, and you give me 2 tons 3,400. So I know with certainty my price cannot go beyond 3,400. Now let's say 6 months come. When 6 months come, okay, price has gone to 2,000. So what I will do? What I will do? Price has gone to 2,000. So I have entered into option contract with the seller to buy gold at 1,700 per ton. So in 6 months time, I have, okay, at the time of contract settlement, the price of gold is 2,000. So what I will do?
Can use the 1,700 option.
Huh?
We can use the 1,700 option.
Yeah, so basically I use my option because I have a contract and tell him to, okay, pay me, give me at 1,700 because I have already entered into a contract. Now let's say the gold price drops to 1,200. Now in 6 months time, when I want to settle the contract, price has dropped to 1,200. So what I will do?
You have to pay 1,700 as an agreement.
Anyone else?
We don't implement the
I think
option.
there is no agreement, so we can go
Sorry?
to option.
First one, okay, let's one by one. First one, first lady.
Then we don't implement the option
Okay, why?
because we have a disadvantage.
Okay. Why you can't, you will not do that? Tell me, that is the important thing.
Because it's the option, so not like the forward contract. So we can either implement or not implement
Exactly.
regarding our cost.
Exactly. Because in option, you are given the choice. Forward contract, you don't have a choice. No, option, you have a choice. You can decide. So if the price is below the agreed price, then you will not exercise the option. You simply forget about it. The option writer does not have any choice. Only the choice is with for the buyer. Okay, option buyer. For do that, only thing is you have to pay a premium to the seller. So it's like insurance. Okay. So you option buyer will pay a premium to the seller and enter into an option contract. So this is a classic simple example to understand what is option. Now in option, always the buyer has the choice, not the seller. Whatever the buyer willing to do, seller need to honor that. If I decide to go with the deal for buying, the seller need to sell me. Okay, seller does not have choice. The seller choice is with the option buyer. Okay.
So what are the benefits to the seller?
Seller also has different scenarios because seller may be entering into a option looking at many other things in a market, in a like a normal market, in a other market, buying and selling. Now, let's say you take example of normal. Let's say you are buying a share. Now you buy. Now the price has pretty gone up. Still, when you sell, there is a buyer to buy it. There's a seller to sell it. So it's in a market. Each body evaluate its benefits and costs because he get a premium. The main benefit is he get a premium. Okay. To enter into a option, you pay me something at the beginning. It's like if you look at insurance. Now insurance, what is the benefit for the insurance company? Huh? If you look at the accidents taking in Sri Lanka, I don't think no one will insure your vehicle. But it is a benefit for them. Because premium is benefit, right? And also they also look at other market conditions. You see, it's like insurance now. Insurance company asks, okay, you pay me 100,000, I will protect your vehicle for 10 million. So you simply pay 100,000 and get a cover for 10 million. So if your car is stolen by somebody, for 100,000 you pay, they will pay you 10 million. You see? Same thing. So in a market, when the buyers and sellers deal, so they look at their individual benefit, but mainly the premium. So they will collect you a premium to enter into a option transaction, right? Clear? Okay. Now, when you tell options, there are two types of main options: call options and put options. And there are other options like caps, floors, and collars. Okay. So let's look at the cap. Sorry, what is the call option? Okay, not cap, call option. So what is the call option? Call option is something which gives the right to buy something at a future date at an agreed price. Right? Right? So call option gives the right to the buyer to buy something at a future date at an agreed price. Put option is a option given to a seller. Option given to the buyer of the option to sell something at a future date at a future agreed price. Right? So remember the two difference. Right? So what is the call option? What is the put option? Tell someone. Can someone tell that? Can someone tell what is a put option, what is a call
Call
option?
option benefit goes to buyer and put option benefit goes to seller.
Always option benefit both option benefit the buyer. The option is benefiting the buyer, not the seller, because seller doesn't have a choice. Okay, whether it's a call or put option, benefit is to the buyer of the option. Buyer means not the buyer means the hold of the option. Now a buyer can buy either a call option or put option, right? Now call option gives the buyer the right to buy something. Put option gives the buyer of option to sell something. Don't mix up that too, you know, buyer of the option and seller of the option. Always, whether it's a put option or call option, buyer of the option has the right, not the seller of the option. Right? Okay. So, what point, in what scenario a person would buy? Let's say example, practically, a person, let's say your bank, okay, forget about bank, let's say commodity. Under what circumstance, to cover what phrase? Let's say gold, take example of gold. Under what circumstances, now you have a whole stock of, you want to buy some gold. So under what scenario, anybody would enter into or buyer would go for a call option?
If there's a price increase in risk,
If there is a possible price increase, you will go for a call option because you can buy at an agreed price, even the price increase. If not, you will not exercise the option. So under what scenario you will go for a put option as a buyer of the option?
if there's a price decrease in risk.
Okay, price decreasing. If you are holding something, your value will come down than the expected value, so that you can enter into a put option. It will give right for you to sell at a higher price than the market price. Okay. Now, can you give an example in terms of bonds, interest rate bond related bonds? Okay, little bit linked to interest rate scenario. Now, give an example in terms of buying and selling of bonds. Buying and selling of bonds. Can you give a specify under what circumstances you will go for a call option or you will go for a put option? So this is your ability. This is a risk manager's ability. So we know in a normal good what happened. Same thing, but related to interest rate.
When the interest rate goes up, the bond value will come down. At the time, the holder of the bond have if they are entered into the put option, they can sell it to they can realize the put option.
Okay, can you little bit again tell that there were some important points in your answer. Can you elaborate a little bit or repeat again what you said?
When the market interest rates goes up,
yes.
treasury bonds prices will automatically comes down in the market.
Yes. Okay.
At the time when the persons who hold the put option related to the bonds, they can sell it because they can finish off the bond.
So you are talking about somebody holding bonds.
Yes.
Okay. Yeah. So let's say, okay, you are almost correct. Now let's say you are holding some portfolio of bonds. Now you don't want to sell it today, you want to sell it in the future, 6 months later. Okay, 6 months later. So the risk is what? What is the risk? If you are holding bonds and intend to sell that in 6 months' time, what is the risk to you?
Fluctuation in interest rate.
No, don't tell that. Particular interest rate. Now, if you are holding a bond, what is the risk specific? Not always.
Interest rates going down.
Interest rate going down. Anyone else?
Rates going up.
Rates going up. Anyone else? Okay, not anything else. No, it should be either going up or down. No, yeah, it's going up because if the interest rate goes up, market yield goes up, price will drop. That's what the original you spoke first said. So the risk to you is when you are holding a portfolio of bonds with the intention of trading it in the future. Let's say 6 months later, your worry is rising interest rates. Okay, rising interest rate. So if the interest rate rise, the value drops. So what you can do is, okay, remember you did a similar thing when we did forward contract. So what did we do in a forward contract?
Micro hedging to a particular time.
Remember, we did an example. Yeah. Here, hedge. How did we hedge? Sell 3 months forward. In that particular example. So now what we have to do? Now we are talking about options. So what we have to do? So now we are dealing with options. Okay. What we can do?
Go for a put option.
Put option, exactly. Because the put option gives you right to sell. Right to sell. So you buy a put option. Don't mix up. Huh? You buy a put option which gives you right to sell. So you go to a counterparty and identify a counterparty who want to be a seller to the option. Seller to the option, seller to the put option. Each option has a buyer and seller. If you want to buy a call option, you have to find a seller. If you want to buy a put option, you have to find a seller. But who get the rights? Who get the right?
Buy of the option.
Buyer of the option. So you go and find a seller of a put option and you will buy a put option. Remember, you have to mention correctly. You have to buy a put option. If there is a question, you have to tell what you have to do. You have to buy a put option or you have to sell a put option. You have to buy a call option or you have to sell a call option. That depends on your scenario. You can sell a put option in certain scenarios. You can sell a call option. So here, since you are talking about the holding of a bond portfolio, the risk is interest rate increase, price come down. You go and find a seller who will enter into a put option with you. So you buy a put option which gives the right to sell. So 3 months later, if the interest rate increase and price drops down, still you can sell to the, you can sell to the seller of the put option the required bonds. So when you sell, what the seller of the put option need to do? What does the seller of the put option need to do? What he has to do?
Pay the agreed amount.
He can do what? Okay, agreed amount, what? Seller of the put option? Agreed amount is right, but in doing what?
He has to pay us.
Yes. Okay, usually difference, but theoretically, when you, I mean, if you talk about physical time, when you sell, he need to buy, but in practically, you will get the difference, right? You will get the difference, right? So that's how option work. Now, what is a cap? So, okay, I couldn't complete. So, under what circumstance, somebody will buy a put option, and what circumstances somebody will go for a call option. So, somebody who will be holding a portfolio of bonds and intend to sell in the future under a trading stock, expecting a possible rising interest rate. And similarly, if you are a person or bank who need to buy certain interest rate related instrument, thinking interest rate will
Drop down.
drop down and price will go up. Price will go up, then probably you will go for a call option. Okay. So it could be, there will be different ways it happens. Now I just talk about a stock of bond you want to sell or buy in the future. So depend on that. So there may be other scenarios which you have to apply rightly when you want to issue what you call the portfolio of new instruments and so on. All this you need to look at. Okay. Now, cap is a call option on interest rates, often with multiple exercise date. If interest rate rise above the cap rate, the seller of the cap compensates the buyer in return for upfront premium. Now, cap gives, now this is another way, cap gives when you have a multiple instrument with a multiple exercise date, okay, and you need to pay interest based on a maybe most probably based on a what you call the variable rate. So it sets a maximum limit. So let's say I am paying you this much, but the maximum I pay is this much, right? So that's the cap. So if the market interest rate goes above that, seller will compensate you. But again, you have to pay a premium. Okay. So that's how you do it. So for example, bank buys a 9% cap today from another bank with a notional face value 100 million. Cap has a 3-year maturity with exercise dates on year 0, 1 and 2. So now this is a typical flow diagram of a call option, long call option. Long means buyer. Okay. Now let's say 3 months LIBOR at 4%. Okay. So if you enter into a LIBOR 4% option, if you buy option, call option, buy a call option. So this is how it looks like. You will, up to 4%, you don't worry. Because you can borrow whatever at lower interest rate. But if the interest rate goes above 4%, then you will have advantage because the seller will settle you the difference. So this is your benefit beyond 4%. Okay. So this is the cash flows depending on the flow rate. Sorry, the agreed rate, 4%. So these are the value dates. In each value date, if the rate goes up, you will get a positive payment each value date. Now here, in this value date, you don't have to worry because rate is anyway below 4%. This value date, you don't have to worry. You can borrow from the market. But here, when the value date rate goes up, then you will get the interest differential. So what is a flow? So flow is a put option on interest rate, often with multiple exercise date. If the interest rate falls below the flow rate, the seller of the flow compensates the buyer in return for an upfront premium. So that's like when you give a loan. Now for example, you give a loan to a customer at a floating rate. Okay. So what is the risk to you? When you give a loan to a customer with a floating rate, what is the risk to you?
Rate reducing risk.
Rate reducing risk. So the rate will come down so that you can do it set a flow. Okay. But if the rate goes below this, still you have to pay this much. Right? So that's how you have to do. Right? So the put option looks like this. Anything below you get a benefit. Anything above 4%, you will be not exercising, you don't have any payoff because you are at an advantage anything above the flow rate. So this is how anything below flow rate at the value date, you will get in the difference, but anything above, you don't exercise. Any questions? Okay, just to look at a structure, how a structure will looks like. Now here, buying a flow on a 3 months LIBOR to hedge aggregate balance sheet risk of from falling interest rate, right? So now this particular bank has lended at prime interest rate at 1% and pays depositors at 3.75. Sorry. So what is the risk to this bank? What is the risk to this bank?
Rates going down.
Rates going down. Why?
More than 3.5.
Huh?
Below prime rate, then
Yeah, what is the why rate going down?
Because the bank has to pay a fixed amount to the depositors even though the rates goes down, but from loans we get only a lower.
Okay, because when the floating rate loans are there, when the interest rate goes down, you will get lesser income from your loans, but for your depositors, you have to pay a fixed rate of 3.7%. So strategy, so this is one strategy. Okay, what you can do is buy a flow on 3 months LIBOR at 2%, and sell a cap on 3 months LIBOR at 3.5. Okay. Sorry, I have gone far. Sorry. So what you can do is buy a 2.5% flow on 3 months LIBOR. So you will buy a flow so that your interest rate will not go beyond that 2.5%, right? So you enter into a counterparty with this option, which is a flow, but you have to pay 0.3% as premium for the deal. Okay. So let's look at the scenario. So let's say the prime rate is 5.5, example, the LIBOR is 3%. Okay, LIBOR is 3%. So your cash flows in the balance sheet on your loans, you get how much? If prime is 5.5, you will get 6.5, and deposits you pay 3.75. So your spread is 2.75. On the flow, you have to pay how much? 0.3%. You have to pay 0.3%. So you will end up with a margin of 2.45%. Okay. Now let's say rates fall to 100 basis points. So if the rates fall to 100 basis points, and also the LIBOR falls to 2%, because parallel shift, prime rate goes down by 1%, LIBOR also goes down by 1%. Okay. So what happens? Your margin will decline by 1.1% to 1.75 because of your borrowing, loan income went down to 5.5, but your deposit rate is 3.75. But on the flow, what happened? There's a flow between 2.5 and 2. So you will receive 0.5 because there's a flow. You will pay the difference between the LIBOR and the flow rate, the market rate and the flow rate. So you will get 0.5, and but you had to pay the premium 0.3. So you get a positive income of 0.2. So you are better off than if you didn't have a flow. So you will get 1.95. You see. So you are somewhat better off having this flow. Otherwise, your net interest income would be 1.75. But let's say if the prime rate drops to 3%, then you will be ended up with a negative margin. 3% negative margin. Let's say prime rate. Okay, no, negative. 3% means here 4%. So you have ended up with 0.25. Okay. So if it is 3%, the LIBOR also comes down by 2.5%. So that means 0.5%. So here you get 2% and minus 3%, 1.7%. And this 0.25, 1.95%. You see, if you didn't have a flow, you will only end up with 0.25, but which ended up with 1.95, right? So of course, if the interest rate rise, anyway, you have an advantage. Only thing is you have to pay the premium, so you don't get the full benefit. Okay. You are not worried about exercising the option. So you have to pay only the premium. So you see, because of this flow, you are managing your interest rate risk as a result of falling interest rate, right? Clear? So that's how you can structure a flow when you have this sort of interest rate scenario. Any questions? Anything you need to clarify? Okay. So let's move on to a collar. Now, what is a collar? Collar is a combination of a cap and a flow. It's a combination. So it contains a cap as well as a flow. So maximum and minimum, max and minimum. Okay. Now take an example of reverse collar to hedge aggregate balance sheet risk of loss from falling rates. Aggregate balance sheet risk of loss from falling rates. Buying a reverse collar. Okay. I'll come to that after this. So this is a collar on 3 months LIBOR to hedge against rising interest rate. Rising interest rate. Now look at this structure. Now look at this structure. Now this bank, what is the risk? What is the risk to this bank? What is the risk to this bank?
Interest rate increasing.
Interest rate
Increasing.
decreasing or increasing?
Increasing, sir.
Huh?
Increasing.
Increasing, right. Why? Tell me why.
Because their loan rates are fixed and they have to pay the floating rate for the deposits.
Exactly. Okay, the risk is rising interest rate. Because loans are fixed, deposits are variable. So you have to pay, if the interest rate rise, you have to pay higher rate for the depositors, so your spread will come down. So that is the repricing risk. Okay, what is the strategy? Buy a cap to control the rising interest rate. Buy a cap. So you will have a cap. Whatever happen, you will cap at 3%. And also combine with a flow. Okay, but you will combine with a flow that is the minimum you will give, because otherwise the depositors will also lose. So this is called a collar. So buy a cap and sell a flow. It's a combination. Okay. So look at this structure. Fixed rate of 7% the bank gets from the loan holders loans, and for the depositors, banks will pay 3 months LIBOR minus 0.25%. Now, cap is when it buys a gap, okay, with a counterparty, whenever LIBOR rate goes up, the counterparty will pay him the difference. Let's say about 3%, because current LIBOR is 3%. Assume that current LIBOR is 3%. Okay. Again, to mitigate the risk to the depositors of falling interest rate, it will sell the flow. So sell the flow means what happened? That is below 2%. The differential is paid. Okay, below 2%. Differential is paid to the counterparty, right? But premium for all this transaction is 0.75, right? So think about the scenario. Okay, LIBOR at 3% now. From loans, you get 7%. You pay to the depositors 3 minus 0.25 to 0.75. You ended up with a spread of 4.25, and also you pay for the counterparty premium 0.75. So today, under current scenario, your margin is 3.5, right? So let's say interest rate fall. If the interest rate fall, definitely you have advantage in getting, you're paying less to the depositors. So you will end up with now if the LIBOR rate falls by 1%, you will end up with a positive net interest income or the spread of 1%, that is 5.25. Okay. Because you don't have to exercise anything up to 2%, right? But you pay premium 0.75. So let's say 100 basis point rise. So it goes to 3 to 4. Now, if it is rise, your spread will come down by how much? 1% from 4.25. So your spread will be now 3.25 as a result of rising interest rate. But what happened? You will get this flow, the cap exercised above 100%. Because you have a cap. So you will get 1%. You will pay the premium. So you will get a benefit of 0.25, which will end up with your 3.5%. Right. So you see, because of this, if you didn't have this, collar, what would be your spread? If you didn't have any collar, but rates goes up to 4%, what would be your spread?
3.25%.
3.25%, exactly. Because
Sir, but I have a question.
Yeah.
That when this collar is only beneficial for the interest rise scenario, no, sir. Otherwise, we have a spread of 4.25
yeah.
and
No,
5.25.
Here the collar depends on how do you structure it. Now you can have a reverse collar also, which I'll explain. So when you look at the market scenario, because now say if you just have a cap. If you have a cap which will only protect your part, okay, because having a cap, you will protect your part. But what about depositor? What about depositor? So depositor will not be protected. You see? So that's why this is a collar which will protect both. You see? So which will protect both against the rising interest rate, but having a flow also. If there is a declining interest rate, because anyway declining interest rate, you are benefited. You are benefited declining interest rate. So in the meantime, you protect yourself against rising interest rate also. But depositor will be at a disadvantage rising as well as declining, right? So it protects both also. So you will set a flow, because otherwise you can't market your product.
Investor confident who will.
That's right. So you have to have both, otherwise no one will put money in your bank, because I mean, when your interest rate rising, they don't give me that also. Decline, I will get less also. I will get less also. So this will structure a deal in a better way, right? So in a rising interest rate environment, but if it happens other way also, you can protect. So it's a cap, and usually collars are sometimes beneficial from both parties' point of view. So when both parties want to have a better deal, the collars are much better than one-sided protection, right? Okay, now let's move on to a reverse collar. Now, reverse collar is a buy a flow and sell a cap. Now, here buy a cap and sell a flow. Here buy a flow and sell a cap against declining interest rate. So, now here the structure is different. Now, earlier you have fixed income, floating expenditure. Now, here you have a floating income, fixed expenditure, right? So, what you can do is buy a flow. So, buy a flow means you will set a minimum to your income. Minimum to your income. So, whatever the interest rate comes down, below a particular rate, flow will trigger. Flow will trigger. And also, you don't want to put your borrowers also at a disadvantage for any potential rise in interest rate. Your prime objective is to, protect yourself from falling interest rate. So then you can structure a flow at 2%, a LIBOR at 2%. And I mean, this is just a one example. Huh? Remember that when you see this, you may think this is the only way. And there are so many ways of doing that. So I have given here one example. Sell a cap on 3 months LIBOR at 3.5%. So when you buy a flow, okay, when you buy a flow, and sell a cap, you will pay. So let's say if the interest rate goes up about 3.5%, interest rate here means the reference rate is LIBOR, you pay the counterparty. And if the rates fall below 2% LIBOR, counterparty will pay you the relevant amount for the risk of declining interest rate. Okay, but premium is 0.38. You will get out of the deal, okay, because you are buying a floor and selling a cap. So that you have to negotiate. But the counterparty also has a benefit out of this. All these things happen when each party has own benefit to whatever the opposite mode. Now, counterparty enter this transaction because he has a different, it is not shown here. He may be having also exposure. So he may be this follower may be beneficial for him. So that's why he enter into exposure like this. So if the prime interest rate 5.5% and LIBOR current 3%, you will get 6.5 and pay 3.75, your margin will be 2.75, right? Now let's say rates fall. Now when the rates fall, let's say both prime and LIBOR move parallelly. Usually it may not be the case, but for example, now it's a parallel reduction, 1%. So you will get loan of 5.5%. From the loans, you will pay 3.75. So your spread will be a 1% drop because of the prime rate drop by 1%. Okay. So the payout, now, sorry, this part payout will be, you don't have to pay anything here, but you will get now here you agree to, counterparty agrees to pay you 0.38%. Okay. Because of the structure, then you will get 3.8 here and you ended up with 3.13 under the current interest rate scenario. But here 1.75. Okay. So you will get 0.5. Okay. And you will get 0.38. So you will end up with 0.88. So your margin will be 2.63. If the interest rate rises, then your prime will be 6.5. Let's say 1% rise, so 100 basis point. If it's a parallel rise, then from 3% to 4%, LIBOR. Okay. You will get 7.5 here because 6.5 plus 1. Fixed rate is 3.75. So your spread will go up by 1%, 3.75. Okay. So your payouts would be 0.5 plus 3.8 and the reverse collar net effect is 0.12. So you end up with final 3.63. So if you didn't have this structure of reverse collar, you would have ended up with 1.75 as a result of this interest rate decline. But now you was able to end up with 2.63. I mean, in fact, you can't fully hedge your position, but you are better off. Somebody can ask, I am not getting the same, spread. But here, if you didn't have, you ended up with here. If you didn't have this whole hedge, but because of the hedge, you ended up with here. So it's very much better than this one. If you didn't have this one, right? So that's how, a collar or reverse collar works. So you can apply it for anything. Flow, cap, anything. Okay, so this is a buyer flow. This is a buyer follower and flow and cap selling. Reverse collar. Then here collar, that is buying a cap and selling a flow, and so on. So you can structure anything as the way you want. But only thing is you have to find a counterparty. So there are different counterparties who won't like to take the opposite side, depending on their, because each bank has a different risk. Now, when your bank has a floating rate loans and fixed rate deposits, another bank maybe have a fixed rate loans and floating rate deposit. So you can easily find out a counterparty. Okay, counterparty. Okay, so we'll stop here for a break. We are almost 10:45 and move on to the next part after the break. Thank you. Okay, can we start? Okay, so let's move on to the little bit of risk management policies and procedures, right? So now basically, if you look at interest rate risk management, now basically, two major objectives is to hedge against the equity impact and the interest rate impact on the earnings. Okay, so must balance effect on earnings and capital, but we can't simultaneously control both. So the bank need to identify which is more important in terms of impact. So you start with the static gap analysis. We did the repricing gap analysis, for which we need database support, and then it becomes a dynamic gap analysis, and also create history of rates and databases. How the different interest rate movements and how that was impacted. So you can use simulation modeling, and also we will look at probably next time the value at risk modeling for different risks. I think we focus on the equity risk, but you can do it for this as well. Then determine the risk tolerance, how much the bank has tolerance, and then you decide on the balance sheet targets and the set trading limits. Okay, so that is the final objective. So at minimum, the following should be included in your practices. So the effective policies and procedures designed to control nature and amount of interest rate risk. So there must be set, I think at the beginning of the course for overall risk management, we looked at how the banks should set up the policy framework. There we discuss certain things in respect of interest rate risk as well. Then, so this will include clearly defined limits and lines of responsibility and authority. Whatever the changes based on plus or minus, some basis points. So here, depending on your income, whether it's 100 plus, 200 plus, or whatever, Then appropriate risk monitoring and reporting systems. So you need to have an appropriate system for risk monitoring and also the reporting. And then the systematic internal controls, including internal and external review, and also key elements of risk management process. Right. So there are challenges with interest rate risk management. What are those? Forecast the direction and magnitude of interest rate changes. Now when you look at in the future, it is something very difficult. That one is, what is the direction? Now, certain economies, this is very easy, but certain other economies, this is not an easy thing. So how do you foresee the yield curve? What could be the interest rate direction? Whether you expect a rising interest rate scenario based on macro variable factors, whether you expect rates to be remain in the same levels without significant changes, or rates to be declined. So once you determine that, how much magnitude? So these are difficult things, but as you know, you have so many experts, based on different analysis, you can come to a reasonable judgment about the direction as well as the magnitude, so that you can factor them into your risk management scenario. Gap measures for not accurately indicate interest rate and do not recognize timing difference. So this is again, as I explained you at the beginning, now the timing differences are not recognized in the gap analysis for assets and liabilities within the same method. So that's why it is better to have a shorter gaps, not very lengthy gaps. Because I showed you example where when you have a very lengthy gap. Now, for example, if you take a gap of 6 months, so within that 6 months, there may be significant changes in cash flow difference, which you may not detect. So within 6 months, within the next 10 days, may be the significant difference. So you don't capture that. Okay, so basically then if you don't capture that, you will be in real trouble if you don't manage it properly. So shorter gaps would be, ideal, which solve this problem, but you need to look at the timing differences as well. So duration is a good measure for small changes in interest rate, but you need to do the changes for any adjustment for convexity. We discuss over this. What is ideal? What is ideal for customers is not ideal. Now, this is what we explain in a rising interest rate environment. When your deposits are priced at a variable rate, it's good for the customers, because whenever the interest rate rises, it will benefit for them. But from a bank's point of view, it is not good, because if you have a fixed rate loans, then your net spread will come down. So always you have to have a striker balance. Similarly, on the loan side, if you have a floating rate loans, and the interest rates decline, you have the other way impact. So your income will be affected, and your net spread will be affected as a result of decline. So the customers will be happy because they have to pay a lower interest rate, but you are not happy. So then you have a methodology to balance them. I think as we saw in the last couple of slides about collars, so which will pay the benefit to both. When you structure a collar, you can have a two-way impact from your point of view as well as depositors' point of view. So there may be monitoring reports, which many of you commonly use in your banks, various MIS reports, asset yields, liability cost, how your yields are on your asset, how about your liability cost, because those are the key drivers of deciding your spread. How do you adjust them, what changes you need to do, Then also net interest margins, variances from prior period and budget. So how did you forecast NIMs to be in particular year? Up to now, how much you have realized? If there are adverse variations, how you can readjust your portfolio to ensure that you achieve the budgets and you maintain the expected net interest margin, and also to identify problems that led to differences, either adverse side or the positive side. Longer term interest rate margin trends. So how do you see the trends in the long term interest rate margins? Rate sensitivity positions like repricing gaps, and also static and dynamic gap. Dynamic gaps, you reprice, you look at the gaps regular basis and try to adjust based on your gap ratios to a somewhat comfortable level. And also, if there are exceptions for the policy guidelines, then you have to examine them carefully. What are the reasons and whether there are any risk areas or whether any violations and so on. So objective of the interest rate risk examination is to evaluate a bank's fund management strategy. So basically, now if you look at interest rate risk analysis, to look at the bank's fund management strategy, volume, and so basically this is how you look at your own ALCO. Within your own ALCO, how do you look at the things in terms of interest rate risk management? Volume and composition of asset quality in relation to liability structure, how the composition of assets in relation to liabilities. Funding volumes and composition of liabilities, the funding, how the funding have come from, and what things you have to be keep in mind. Diversification of funding sources. So what are your funding sources, and whether you have diversified depending on the different risk elements. Okay, the net funding gaps, the composition of on and off balance sheet portfolios. Okay, the relative cost of funding, again very important, how much your cost of funding with respect to different sources. Okay, short term, long term, medium term, and so on. Also the type of instrument, different types of instrument, whether it's equity, whether it's deposits, whether it's maybe debentures, and so on. Approved policies being implemented. Okay, whether the bank is following the approved policies in the right way. Contingency planning, and whether you have a contingency planning in place, and if you have activated contingency planning, what were the outcome results and any problems you found. Because the contingency planning is very important when it comes to, especially the when it comes to the interest rate and liquidity related risk management, especially at difficult times. And also important, all this comes by way of information through your NMIS systems. So you must have a very good management information system that can provide all this information, and also the level of and the skill of your staff who understand these things in a more broader way. So interest rate risk analysis is part of core and expanded analysis of earnings and sensitivity to market risk. So overall, if you look at perform core analysis, so are the policies, procedures adequate? So whether your policies and procedures adequate. Is management complying? So the second thing is whether the management, okay, whether they are adequate. Okay, so whether they are complying. Okay, so whether they monitor the IRR properly. Then what are the earnings vulnerable to interest rate changes? Okay, so they are not everything affect or income or equity as a result of interest rate changes. So you have to identify vulnerable areas, the potential areas of risk as a result of interest rate change. Are there proper controls in place? Whether you have proper controls in place to mitigate. Is capital sufficient to or sufficient relative to risk profile? So whether capital is sufficient to risk profile. Okay. Okay. Then do co-analysis are risk adequately managed. Okay, so you have to do a co-analysis and are risk adequately managed. So if it is yes, okay, you can finalize your not you perform expanded analysis and find out are there deficiencies immaterial to supervision of interest rate risk. Are deficiencies immaterial to bank's position? That's very important. Are risk adequately managed? Yes, then again you can prepare a management report. Otherwise, again perform impact analysis if the risks are not adequately managed. So this is a cycle which you start from the policies and procedures and see whether the management comply, whether the risk is managed properly, and identify the impacts on equity. Okay, so if we don't have any proper management system, please structure in such a way you do the further analysis to identify the problems. Then otherwise you come up with your own reports on ALCO reports, which sets the background for the overall risk management structure. So basically, in summary, the interest rate risk affects both earnings and economic capital. So a strategy should address all interest rate risk factors. Risk limits should restrict earnings or capital volatility. Okay, that is NIM, net operating income, equity value, and regulatory capital for given interest rate movements, reflecting banks' complexity and capital strength. Okay. Okay. So basically, we have covered in detail the interest rate risk part, very important element of overall risk management from a bank's perspective. So we looked at different types of interest rate risk that could derive: basis risk, yield curve risk, embedded option risk, repricing risk, and there are so many items we looked at, and then different models which we can use for interest rate risk management, and also derivatives in detail last couple of days, how different instruments like forwards, options, swaps, futures can be used to manage interest rate risk. Because these derivatives are used for managing foreign, what you call other risk as well, now especially foreign exchange risk. Okay, so here our focus was only on the interest rate risk, right? So that then finally we end up with basic overall policy framework. So with that we can conclude the interest rate risk management part. Are there any questions before we move? Okay, if we don't have any questions, let's move on to the value at risk modeling. Okay. I think we begin the market risk is with this slide, the potential risk that value earnings of a financial institution may decline due to exposure to systematic risk factors. So what are those? Interest rate risk, foreign exchange risk, equities risk, and the commodities risk. Now, we already know there are different scenarios in the case of interest rate risk to measure the risk. So basically type of measurement, scenario analysis, statistical analysis, and there are so many things we can use. Now, if you look at scenario analysis, measures the change in market value that would result if market factors were changed from their current levels in a specified way. So assumption about probability of changes made. Okay. So it's something like looking at different scenarios which can take place in the market, and based on certain assumptions of probabilities, and evaluate the impact. Now, stress test is a common example. It's a measurement of the change in the market value of portfolio that would occur for a specified unusually large change in a set of market factors, right? So the scenario analysis is a typically very good model. Look at different scenarios of different macro variables. So here, if you look at interest rate, if we are talking about interest rate risk, then how would be the impact on your bank, right? Now, value at risk. What is value at risk? Now, of course, I couldn't mention about statistical analysis also. Use statistical data to look at this, changes. And for example, what you call distributions, different distributions, then hypothesis testing on certain areas, and trend analysis, and so on, right? So what is value at risk? How many of you heard about value at risk? I think this is again a common term used in all banks. All of your banks. Anyone have any idea? Any idea, anybody? What is value at risk? Have you heard about value at risk? Any ideas? In your banks, on what areas you are using value at risk? VA, which you usually call VA. How many banks have you heard about VA in your banks? No one? I think all of your banks, most of you, not most, all, I think. VA is a very common thing. Your bosses always ask, what is my value at risk? On this, that. Okay. So value at risk is an estimate of the worst possible monetary loss from a financial investment over a future time period. So here you look at, from a risk perspective, what could be the maximum loss from a particular investment I would end up over a particular time period, maybe 1 month, 2 months, 3 months, 6 months, 1 year, and so on. For most financial investment, the return over a future period is a random variable. That is everyday return, 1 day % return. So if you look at now, you are invested in stocks, okay, and if you invested in bonds for trading purpose, remember trading purpose, because if you hold it for maturity, you don't have any problem. You will get your face value at the maturity. But if you use it for trading, all these market variables matter. What is the price? So if you look at the price returns, maybe everyday return, maybe 2%, 3%, 5%, negative 6%, and so on, because the price fluctuates. It is a random variable. So it's a statistical variable. Therefore, the actual future return will also, to some extent, differ from any estimate of the future return. So when it is random, the actual return may be differ from estimate. Now today you estimate, let's say you invest in some hotel stock, okay, hotel stock equities. Then you expect a certain return from this portfolio over a particular period, let's say 6 months, where you are in the trading platform of your portfolio. So you want to sell in 6 months' time, you buy today with the expectation of certain return. But since this is a random variable, actual return may vary. Okay. Hence, a VAR statement has a confidence level attached. Now, that's why when we say, you can't exactly say. So, always we say value at risk with this much confidence. The confidence is the probability. Now, when you say confidence, I am 95% confidence. I am 99% confidence. I am 90% confidence, and so on. So that is defined in terms of the probability that the actual monetary loss will not be greater than the VAR, right? So when you say I am 95% confidence, that loss will not be more than this. So that means actual monetary loss will not be more than that up to 95%. So value at risk is the main statistical model technique used by banks for modeling financial risk. So it's a statistical model. And you will understand when we do questions, beauty of value at risk. It's a very interesting area. So let's move on to the little bit of statistics. So it measures what loss level is such that we are X% confident it will not be exceeded in n business days. So when you use VAR modeling, it tells us our loss will not be more than this. I will not incur loss of more than 50,000 over the next 10-day period. Now I am just giving example. Now here the n business days. So it could be anything, 1 day, 2 day, 30 days, 60 days, and so on. So it will not exceed this much, let's say 50,000 over the next 10 days in this 10. How much confidence? I am 95% confidence. I am 99% confidence. I am 90% confidence. Now, from a regulatory perspective, now, especially when banks rely on modeling for different risk assessment, now we will understand when we discuss the Basel capital framework, there are different methods that suggest for market risk, standardized method, model-based approaches. So where the banks are supposed to provide capital based on the models. If you follow a modeling now in Sri Lanka, most of your banks follow the standardized approach, not the model-based approach. So regulator has allowed you to follow the standardized approach, not the model-based approach. But if you follow the model-based approach, then regulators can set a VaR limit. So sometimes some countries, it says, okay, your market risk capital should be K times your 10-day 99% VaR. Right? So don't worry about this one too much, because that's some Basel, based on Basel, some, arrangements in some countries. Okay, let's look at the graphical representation. Now, the value at risk is a measure of the risk in a portfolio over time, quoted in terms of time horizon and a confidence level. Example, 10-day 95% VaR is the size of loss X that will not happen 99% of the time over the next 10 days. So look at the graph. This is like a normal distribution. So if you look at that X, now let's say X is 50,000 rupees. So what is this meaning? So we are 95% confidence over the next 10-day period, our loss not exceed, let's say X is 50,000. So it gives some comfort for the risk manager, the maximum possible loss with the particular confidence over the next time period you target. It could be 10, it could be 20, and so on. So based on that, you can structure your investment scenarios. Now, so there are different confidence levels you attach when you express the value at risk. Now, very common to standard value at risk levels are 95% and 90%. So 95% means 1.645 times of the standard deviation from the mean. 99% is 2.33 standard deviation from the mean, right? So don't worry too much about these things, because these are given in the statistical tables. From your point of view, just to elaborate. So if you look at, this is the mean. I think most of you have done mathematics, in a normal distribution curve, you have a mean 0 and variance 1. So any deviation from mean to either side is called the standard deviation. So 99% confidence mean, the 2.33 standard deviation from the mean. 95% means 1.645 standard deviation from the mean. So the risk management idea is to maintain the loss within that particular deviated limit. So the worst case scenario. Now worst case is 5% in the 95% case. Worst case is 1% in the 99% confidence interval. Now, what is the loss level that will not be exceeded with a specified probability? This is what I said at the beginning. Here, now this example. So the loss will not exceed this much, X. X may be 100,000, 50,000, and so on. But CVA, or expected shortfall, is the expected loss given that loss is greater than VaR. So CVA is the loss if the expected the loss is greater than the VaR. Although CVA is theoretical more appealing, it's not widely used. So the commonly used is the normal VaR. So what are the advantages of the VaR? It captures an important aspect of risk in a single number. So it's very easy. You have to say the 99%, the confidence level and the number of days. Easy to understand. Ask the simple question, how bad can things get happen? So it is talk about a worst case scenario. How bad can it? So for example, I think if you are cricket lover, you know that announcers on the way of the match, they forecast. If they score at 6 runs per over, this would be the score. Okay. If they score at 8 runs per over, this is the score. And they ultimately say the worst case. The worst case is this much. They score 200, they score 250, they score 300. So it gives an idea about how bad, so what is the, lowest possible score the team can play. Okay. So similarly, here the VAR tells what is the, worst thing that can happen in your investment. Worst thing, the worst loss that can happen as a result of different macroeconomic variable changes, right? Okay. Any questions so far? Everybody is very silent. So you must be very active when it comes to a very interesting lecture like VAR. Anybody involved in VAR calculation of your banks? Anyone? I think some of you in the risk area. Definitely, you should be get involved. No questions? Okay. Now, look at an example. How do you calculate VAR? Now, when you calculate VAR per particular day, a day VAR, then you can calculate VAR for any number of days. Now, your boss will ask, okay, tell me value at risk with 95% confidence over the next 30 days. Then he asks, okay, tell me for the next 60 days. Okay. So how do you do that? So it is very common to calculate the VAR for day. Daily VAR. That is the value at risk of your investment over a day. Then calculate the 10-day VAR, 30-day VAR, or whatever. Now, if you look at this particular case, 99%. So if you do the 10-day VAR, simply you take the root 10 into 1-day VAR. So it is always better you work out the 1-day VAR for any investment. And then convert into any number of VAR. Now, for example, I will show you. So, okay, tell me I want to calculate VAR for 60 days. I know 1-day VAR. Then what should be the 60-day VAR? If I want to compute 60-day VAR, can someone tell?
Square root of 60 into 1-day VAR.
Square root of 60 into 1-day VAR. So pretty simple. So always compute, when you want to compute VAR, compute 1-day VAR for a given confidence level and convert into the number of days you are proposing, right? Okay. So now the most important part is, how do we measure the VAR? How do we measure the VAR? Now in calculating VAR, there are different different method approaches. Now I have given here 3 approaches: historical simulation, variance covariance approach, and the Monte Carlo simulation. Anyone has heard about these things, or at least tried to apply? Anyone? Many bankers should know about these things. Anyone, at least, even though you have not anyone heard about these methodologies? even when you do your other studies or anything? Historical simulation, various covariance analysis, Monte Carlo simulation. Anyone heard about it, Horesha? In your ADB analysis?
So basically, in my studies, we have used Monte Carlo analysis, but for the due diligence, our due diligence department use all these three methods.
You use Monte Carlo?
Yes, and there's various covariance. I have not involved in, but they are using both the methods.
Okay. So I think many banks, many analysis, Monte Carlo simulation is very popular. Okay. Because this is a model-based technique on random trials. Okay. Anyone else? In your bank, have you at least now seen your colleagues are doing this? No? Okay. So please have a look, or at least learn from your friends, how you can do, how they do it. Because we learn things, but we need to know how they are used in practice as well. At least the things we are doing here in the local context, right? So ask your colleagues in the risk management departments, especially the fund management. In your fund management divisions, all of them are doing VAR. So go and ask your colleagues in the fund management division. They may not tell you the numbers, but practically, because it may be a confidential information, but they will tell how they do it. All of your treasury operations, fund management area, VAR is the most popular instrument. I think all of your banks are doing. So have a look at it. If you are coming from an investment bank, definitely VAR is the most popular. So have a look at it. Because then you realize, we can talk for days and days about this theory, but ultimately no use if you really don't look at things happening actually, because we are telling just numbers here, but in real practice, you are playing with the actual data. Now, when your fund managers work out VAR for certain, investments or whatever, that's with real numbers. When your fund managers calculate the duration, that's with real data, not this theoretical data. They look at real investment, they look at real bonds, they look at real maturities, they look at real yield, they look at the duration. A duration is again a risk management tool in most banks. So have a look at it and see. So that's interesting for you all, rather than just, listening things happening, but then exactly, oh my God, this is what is happening. This is how. So practical thing is quite different. You don't have to manually work out. All this naturally come when you build, but look at the scenarios. Okay, how this happened? This is the risk. Okay, anyone else? If you have any thoughts, you can express. But otherwise, we will move on.
Sir, I want to ask one thing, that when they fix the fund transfer pricing, they will for the units, they will calculate along with this VAR. I'm not. I want to ask a question.
That of course I can't say exactly. Okay. Probably that depends on your policy. Now, fund transfer pricing again between different business units, where you have surplus funds and excess funds, surplus to excess funds, you transfer between. But I'm not sure whether value at risk is used there, because as far as I know, I don't think so. But probably you can check with your own colleagues. But as far as I can think of, I don't think any relationship. But maybe I can't say no. Also, maybe certain things you capture, maybe considered as inputs. Okay, inputs. Okay, so maybe your head office is transferring funds for your branch based on a transfer filing mechanism, maybe from a branch head office. Now, this is again a methodology when importers and exporters do businesses overseas. Sometimes they have a overseas branch where transfer pricing is used, but I really don't know, sorry. But just check. But there can be instances, different, information derived from the value at risk could be used, right?
Okay, thank you, sir.
Okay, so we'll move on to the presentation again. Historical simulation approach, variance covariance approach, Monte Carlo. Now, Monte Carlo simulation is very popular because of its random trial-based modeling. Very popular. Okay, let's look at one by one. Okay, one thing. Now, I don't think we have time today to do simulation. And remember, next week, we are running simulations through the Excel. So you have to use all the laptops and get ready for simulation running. So we are running some exercises using simulation for Monte Carlo especially, but we work out some examples for historical simulation and variance covariance analysis also. Get ready with your laptops. And you have to work with me, to get the results. The results will come when you work in your Excel sheets. Okay. So that is a must. Okay, so get ready with Excel sheet. I think all of you are comfortable with Excel. For working, so today I don't know, I think we have only about 40 minutes, whether we have time. So let's start with historical simulation theory. Now, what is historical simulation? Now, when you want to, so this is a one way of statistical analysis. Now, especially now when you look at, if you are a fund manager, now one element is he need to look at the risk as fund manager, whether he will get the right return, expected return, and what is the threat to achieve that expected return. So then when you invest in also, you use different analysis for your investment when you select the investment. Before investing, you have to select the investment. Okay. So there are different statistical analysis also used. There are two types of analysis you generally do. I'm nothing to do with simulation. Okay. So what are the two basic types of analysis an analyst would look at before taking an investment decision? Based on historical information. So that's why I want to link you to historical simulation. Historical information. Two key types, two names given. But even if you can't give, just tell me those. Before making any particular investment decision, you do some conduct. And now, before granting a loan to a customer, what do you do? Tell me.
The return of that investment and the period, how quick we can.
No, I am telling you, before granting a loan, what things you look at?
Repayment capacity.
Repayment capacity. How do you do it? How do you assess the repayment capacity?
Debt service cover ratio.
Okay, how do you look at the debt service coverage? I'm asking, how do you do it? I mean, you look at debt service, how you do it?
How many times with their present surplus they can service the loan with the installment and.
No, that's right. I know you are right. But what things to do that? What do you look at?
Customers' past transactions.
Past transactions, okay. But anything else? Can you look at past transaction alone? I didn't get that. Important thing I didn't get. I'm bankers. I think Now let's say I come to your bank. So I will say my repayment capacity is that. So do you accept it and give it to me? That is the
Future
most
cash flows.
Huh?
Future cash flows.
Yeah, how do you do it? Future cash flows based on what? At all bankers, I think this is a very, you look at the financial statements for the last so many years. You ask him to give me the annual report, give me balance sheets, give me profit and loss statement. So this is the key document. So you look at historical data and derive repayment capacity. You look at cash flows, all those, but based on key financial statements. So that is the first thing you do. You tell the customer, okay, give me last 3 years balance sheet, give me last 3 years profit or loss statement, give me last year's cash flows. And then you ask the CRIB to give me a CRIB report. CRIB will tell, okay, he has obtained this, that loan, and he has paid this, he has not paid this, all this CRIB will provide. Okay. So based on the financial statements, you will derive debt service capacity. And based on other banks' information, you will decide whether he can repay another loan with the cash flows. Okay. So you use historical data to measure the ability of the customer to repay your loan in the future. Okay. So that's what you do, no? So build up a database. You look at ratio analysis, profitability, liquidity, working capital ratios, so many things you need to do. Not just the debt service. To arrive at this, you need to assess whether a company is liquid company. You look at current ratio, quick ratio. Don't you do these things in your bank? Very simple, come, okay, repayment capacity, this for giving like that. Huh? So you do all those things. If it is a personal loan, even you ask, okay, give me the salary, where do you work? You know, you do these things, whether to assess whether you have a cash flow. But if it's a company, you have to look at all these details. So similarly, simulation is based on historical data of returns. Historical data of returns of a particular investment. Okay. And you try to structure a distribution. So you trust this distribution. Now, generally, we assume normal distribution. You know, remember I said a few slides ago, we assume random variables. Here. The return over a period is a random variable. So when you assume a random variable, you can assume a normal distribution function, right? Rather than theory, when we look at a question, you will understand better. So don't worry about, much into, putting into your mind that all these things. So it's basically simple terms. In the historical simulation, you look at historical returns. You can look at daily returns, you can look at yearly returns, you can look at monthly returns, anything. And assume random variable and normal distribution function. Okay, so there are random variables and normal distribution function. And build up a distribution, frequency distribution, model. Okay. Frequency distribution model. So that's what happened in a historical simulation. You will understand when we do a question. So the one important thing is, okay, now here we will structure the distribution without assuming any distribution function. So we don't assume, I made a mistake, normal. We don't assume any distribution function. When it comes to variance, covariance, we assume that. But here we don't assume any distribution function. We just develop the frequency distribution using the random variables. So because of that, it is non-parametric. So we are not depending on parametric variables. Now, when it is parametric, you depend on mean and standard deviation. Mean and standard deviation. And very easy to understand and based on only historical information. So the benefits are those. So you look at the historical return data. You develop a frequency distribution. You are not doing any assume parametric variables like in the variance covariance model, and identify a particular confidence level, worst case, and calculate the value at risk, the maximum possible loss. The disadvantage is now, since you depend on historical data, there is no guarantee future will be also like that. It gives some comfort, but future may be quite different. So it is a biased estimate of forward-looking VAR. So those are the disadvantages. But very easy. But this gives some comfort. I mean, all models will not be 100%, successful, but it is a somewhat comfortable model. So let's move on to the variance covariance approach. Now, under the variance covariance approach, what we do is, now we use the data, historical data, but we assume probability distribution function. The assumption is that movement of the components of the portfolio are random and drawn from a normal distribution. So the two assumptions, it's a parametric model. We assume a random variable and normal distribution function. Okay, random variable and normal distribution function. And build the distribution. Arrive at the parametric ratios, standard deviation and mean. Based on that, we compute the value at risk. So when we do a question, you will understand. So there we look at volatilities, standard deviation. So as I already explained, sigma per year equals sigma per day times root 250. Now 250 is internationally accepted working days. Now if you look at, even though you have 360 days, 5 days per year or 360 days, real trading dates are around 252. If you take the non-trading days out, I mean, look at Saturday, Sunday, you don't see any trading in any market. Maybe certain holidays. So roughly around 250 trading days in most markets. Okay, because even in Sri Lanka now, certain public holidays you are not trading, you see. So here the trading date, because return is only based on the trading day. For sigma day, but is sigma standard deviation. Standard deviation measures the volatility, risk. So basically this is the risk. Now we come to the statistics. Okay. In statistical terms, standard deviation tells you about the risk. So we use variance covariance model to capture volatility. So we should define sigma per day as the standard deviation of the continuously compounded return in one day. Okay, continuously compounding return in one day is the standard deviation. So it is the standard deviation of the percentage change in one day. So if you take, now let's say you have invested in a equity portfolio. Your bank has invested in equity portfolio for trading purpose. Then every day when the market price changes, your portfolio value changes. Then you compute the daily return. Okay. And likewise, you do calculate daily return for the last 30 days and run covariance variance model and calculate the sigma, the standard deviation of daily return. then that is called the value at risk. Daily value at risk. Daily standard deviation, and you can convert into a value at risk using the confidence level. Right? You use, because this is the volatility, then value at risk you can compute using the confidence level for day, 3 months, 2 months, 165 days, 365 days, and so on. Now take an example. Now you have a position worth 10 million. Now you can apply for anything now. Let's say you have a position worth 10 million in John Keel shares. John Keel shares. Okay, so this is Microsoft. So volatility per day is 2% per day. So based on the historical return, it has been estimated. You can do this for any investment, your local investment here. Okay. The volatility, simply you know how to calculate volatility now using a spreadsheet. The standard deviation, you go to a spreadsheet, put up the returns and give a command to the Excel, give me the sigma and give me the mean. So you can do it. That is a basic statistics anybody can do. So based on whatever the calculations, the volatility per day is 2%. So if it is 2% per day, that's about 32% per year based on the formula. Now we want to compute the 10-day VaR. 10-day VaR. Okay. Now volatility per day is 2% per day. So what is the standard deviation of my investment within a day? Volatility. Within a day, what would be the volatility? Of my investment? Can someone tell? If my daily volatility is 2%, for a given day, what would be my standard deviation in this particular example?
Can multiply by 2%, 200,000.
Huh?
10
2%?
million, 10 million multiplied by 2% into equals 200,000.
Exactly. So my investment value is 10 million. Per day, volatility is 2%. So my daily volatility is 10 million multiplied by 2%, 200,000. So every day, my portfolio value could go up or go down within this much, up to 200,000 positive or up to 200,000 negative. So that is the daily volatility. It could be either way. Volatility means either way. Okay. Now what is for 10 days? My daily, now daily volatility is this much. 10 days volatility, I have to multiply 200,000 by root 10. Remember? You want to find for a 10 day, you have to multiply days volatility by root 10. Here 252. So root 10, my daily, 10-day volatility is 632,456. Now, I have a confidence level, 99%. I want to compute the value at risk for 99% confidence level. Value at risk for 99% confidence. Now, for that, we can use the normal distribution numbers. Remember, I mentioned you sometime back. Yeah. The normal distribution values for 95% is 1.645, 99% is 2.33 standard deviation. We can use that. So for 99% confidence level, my value at risk for a 10-day period is 2.33 times 632,456. Okay, at 99% confidence level. So what does it mean? Now, what is the interpretation of that? What is the interpretation? Anyone? What this number tells us? What this number tells us? No one?
We are 99% confident that our loss in the next 10 days will not exceed this amount.
Who is that, please? I can't. Anjali.
Yes.
Okay. So we are 99% confidence that our loss will not exceed this amount over the next 10-day period. You are exactly right. Okay. So that is what this message says. We are 99% confidence. Okay, so 99% confidence means you are great confidence. There is no chance of your loss exceeding 1473621. So as a fund manager or risk manager, you know what could be the possible maximum loss with 99% over the next 10-day period. So you can estimate for next 30 days, 100 days, 360 days, anything. So you know the possibilities. So that is the risk, no? Risk is probabilities, nothing else. Now today, now you want to go somewhere, you want to go to maybe Kataragama. But you look at the sky, cloudy. So you have to take a decision, again on risk. Okay. So what you can do? What will you do? So you have done the risk management. What will you do? Tell me. You can do the value at risk. How do you do it? Anyone? These are things you do on your day-to-day life, not in risk management. What do you do? Ask God whether it will rain or not. Whether God will tell you that. Ask your friend. What can you do? Tell me, what can you do? It's a simple thing I'm asking, not the risk management.
We see the weather forecast.
Exactly. You see the weather forecast, international forecast. And see, if you go to a weather, I don't know what is happening in Sri Lanka, but if you go to international weather forecast, they will tell for the next 5 days exactly humidity probability is this much, raining probability is this much, and temperature is this much. When you go abroad, that's the best thing you can do. You can plan your trip very nicely. Next 5-10 days. Even if there is a change, they will tell later. All these problems, have a look at the weather forecast, international. They will tell the probabilities. So that is the confidence level. They will tell, even they will forecast during daytime 8 to 10 this much. If you look at New York, 8 to 10 this much, 10 to 12 this much, night this much. And also cloudy, partly cloudy, rain, and probability, forecast. Go and have a look at your weather forecast today. So that is the risk element. That is the value at risk. So if you plan to go there, if it's pretty bad, windy, so you will not go. Therefore, you will go and you will adjust your speed, all those things. So that is basically risk management. You look at the weather forecast. You are exactly right. And look at all this probability. Even flight movements are like that. They look at the satellite forecast. Because they can't do anything while on the way. There's a thunderstorm moving. How can you do anything on the middle of the air? So they look at all forecasts. What is the weather direction? What is the wind direction? And the risk factors. They analyze all the risk factors before they take off the flight. You see? Not just because of weather is fine here. They look at weather on the way. So if you're flying from here to, maybe Dubai, so you have to see in between what could be the weather. Okay. What time, depending on the time. So there are red flags there. Maybe sometime, maybe in Dubai, the pretty bad weather, so you can't do landing there. Okay, so they check the weather conditions in Dubai, not just here. You can take off here, but on the way you can't land. It's a pretty bad weather, unless there are airports, without having any impact. So all these things matter. So pretty simple way of doing here also, simple as such. But we look at some numbers based on the returns. So this tells the maximum loss that I would end up with 99% confidence over the next 10 days. So I know, okay, something very worse happened. This would be my loss. So I can think of, I know what is going to happen. So all the other decisions can be made on this. Okay. Now take example of another stock. Another stock, AT&T. You have invested 5 million. The volatility is 1%. Now earlier volatility is 2%. Now here 1%. So the standard deviation per 10 day is 50,000 into root 10. Because 5 million, 1% means 50,000 into root 10. And Y is 150,000, 144 times 2.33, because normal distribution value for 99% confidence level is 2.3. So the maximum loss that could end up with a 99% confidence over the next 10 days for this portfolio is 368,405. Okay, 368,405. Right. So if you couple them together, okay, sorry. An important factor you can design. Now, when you have so many stocks in your portfolio, what is the benefit? Rather than having a stock individually, better have a portfolio of different volatilities. So what is the benefit having a portfolio? But the one word, with one word you can say. We use a particular word for this method. This is something you use every day in your life.
Diversify the risk.
Exactly, diversifying the risk. You can either concentrate the risk or you can diversify. Okay, so you diversify the risk. Okay, you diversify the risk through adding stocks to the portfolio. Even in a loan is same. Let's say you have only two loans in your bank. Then is the risk high or low? Is the risk high or low? Only 2 loans in your loan book? Or having 100 loans? Which one is better? 2 loans or 100 loans? Risk perspective. Huh? If your bank have 2 loans,
100 loans.
100 loans better, because your risk diversification. If those 2 guys go bust, you end up the story. This is the law of large numbers says. This is also important for liquidity also. We will look at liquidity risk when we look at This is a principle called law of large numbers. So that exactly applies for any portfolio. It could be a loan, it could be a deposit portfolio, it could be an investment portfolio, anything. We will look at that. But before that, let's have some theory for portfolio diversification. Okay. How it, statistically, how it happens. Now, if you look at a portfolio of investment, now let's say you don't have one, you have 3 investment. So the expected return from that investment equal to summation of weight of that first investment in your portfolio times expected return of that portfolio. I'm not going to discuss it. This is basically when you do your portfolio analysis, you do this thing. Just for explanation, I'm not going to discuss in detail because you know this. Those who have done portfolio risk and return, this is the very basic famous formula. Okay. So standard deviation of the portfolio. So standard deviation square. Now, standard deviation is square. What is the name you usually give to square of the standard deviation?
Variance.
Variance. The square of standard deviation, mathematically we tell variance equal summation of I equal 1 to n, j equal 1 to n, wi, wj, covariance I and j. Mathematically it tells, now if you have 3 stocks, there is a relationship, correlationship between each stock with another stock. 1 and 2, 1 and 3, 2 and 3. So this is the variance is a combination of correlation of each stock in your portfolio. I am using the word stock, but each investment asset. And summation of W should be equal 1. If you have 3 stocks, let's say you have 10,000. You have invested 4,000 in stock 1, 4,000 in stock 2, 2,000 in stock 3. So what is the weight of stock 1? Weight. You have 10,000 worth portfolio rupees. You have invested 4,000 in the stock 1, 4,000 in the, sorry, I will use the investment, 4,000 in the investment 1, 4,000 in the investment 2, 2,000 in the investment 3. So what is the weight of investment 1? Tell me.
Yes, sir.
Huh? Weight. Investment 1 weight?
0.4.
0.4. 2?
0.4.
3?
0.2.
0.2. So W1 is 0.4, W2 is 0.4, W3 is 0.2. If you add together 0.4 plus 0.4 plus 0.2 is 1. So the weight should add to 1. Then the covariation ij equal, another term we can use. I think most of you heard about correlation. Now, correlation is the Pij. I mean, this correlation, this is a Greek word. Rho, ij, and sigma I, sigma j. Okay. So basically, the variance of a portfolio, that is standard deviation square, equal I equal 1 to n. So that means 1 to n means if you have n number of investments, you have to take n. It could be 10, 15, anything. Wi squared plus sigma I squared plus weight of I, weight of j, rho ij, sigma I, sigma j. So that's how you can compute the variance. Okay. Any questions? Anything you need to clarify? Okay. So let's look at an example. Okay, let's look at an example. You have a portfolio, 3 portfolios. First, X portfolio. Now, in the portfolio X, you have 2 assets. Okay, let 2 assets in different components. In the portfolio X, you have 25% of asset 1 and 75% of asset 2. And the portfolio Y, you have 50% of asset 1 and 50% of asset 2. Portfolio 3, let's say you have 75% of asset and 25% of asset 2. Now, the asset 1 give you a return of 10%. Asset 2 give you a return of 5%, expected return. Okay, so I'll start with that. So, if asset 1 give you a return of 10% expected return, asset 2 give an expected return of 5%, what is the portfolio expected return under the X? Can someone tell? Portfolio return. If you have a portfolio like this, tell me, what is the expected return of portfolio X? Expected return equal this, WIRI. So tell me that. Anyone? Simple. I think who is talking always, let me ask. We'll ask someone. Anyone? Before we ask anybody. Can anyone tell?
0.25 into 10% plus 0.75 into 5%.
Okay, how much?
3.725.
Sure. You said first part correct, but the final number, you said 0.25 into 10% plus
Yes.
0.75 into 5%.
Yes.
What is the number? You get partial points, not the final answer. So much? 0.25 into 10% is how much? 2.5%, right? Then 0.75 into 5%, how much?
0.02.
3.75. So what would be the addition? Huh? Difficult part you did, but easy part you didn't mention, right? So 3.75 plus 2.5. How much? 6.25. Right? 6.25. Clear? Because your individual return from this is 10. But if you wait only 25%, so that is 2.5. Here you get 5. If you wait 75%, 3.75. So 3.75 plus 2.5, 6.25. Yeah. WIERI. Clear? Similarly, if you have a portfolio like this, you have 50% of asset 1, 50% of asset 2. So what would be the expected return? Don't look at the answer. Answer is clear. 50% of 10% and 50% of 5%. 7.5. So if we have a portfolio like this, 75% and 25%, you will end up with 75% of 2.5, 20%, and 25% of 5%. So that is 7.5 plus 1.25, 8.75. Now, what do you see? What do you see? Anything you observe, that is what I want to bring you down here. Now, what do you see before we stop? I will come to the rest of the part next week. What do you see? The portfolio return has increased when what happens?
When weight in asset 1 increases.
Increases. Weighting of asset 1 increases. And weighting of asset 2 decreases. Why is that? Because asset 1 gives a higher return. So whenever you add more and more to the asset 1 in the portfolio, because asset 1 gives a higher return, your return will naturally go up. Right? Okay. So we'll stop there, because this part I will explain next day because it will take time. How do you couple risk into that? Right? Any questions before we close for the day? Be ready with your Excel sheets and the computers, laptops. We are doing simulation exercises next week all day. Once we complete theory part, next few slides in the theory for about 30 minutes.